How does a GRAT work? Have you ever wondered how you can pass on your wealth to your loved ones while minimizing taxes? One effective method is through a Grantor Retained Annuity Trust, often referred to as a GRAT. Let's break down how this tool works and how it can fit into your retirement estate planning and gift tax planning strategies. First, the process begins with the creation of the trust. The individual setting up the GRAT, known as the grantor, establishes an irrevocable trust for a fixed term. This term usually ranges from 2 to 10 years. Once the trust is created, it cannot be altered or revoked. Next, the grantor funds the trust by transferring assets into it. These assets are often those expected to appreciate significantly over time, like stocks or real estate. The value of these assets at the time of transfer is essential for tax calculations. During the trust term, the GRAT pays the grantor a fixed annuity each year. This annuity amount is determined based on the initial value of the trust assets and an interest rate set by the Internal Revenue Service, known as the Section 7520 rate. The payments remains constant and do not change based on the performance of the trust's assets. Now let's talk about the tax implications. When the grantor transfers assets into the GRAT, a gift tax is calculated on the value of those assets minus the present value of the annuity payments the grantor will receive. Since the grantor retains the annuity, the taxable gift is often reduced significantly. At the end of the trust term, any remaining assets in the GRAT, which means the appreciation of the assets above the IRS hurdle rate, pass to the beneficiaries, such as children or other heirs, without incurring additional gift or estate taxes. However, there are some risks to consider. If the assets do not appreciate beyond the IRS hurdle rate, the trust may have little or no value left to pass on to beneficiaries after the annuity payments. Additionally, if the grantor passes away before the trust term ends, the assets typically revert to the grantor's estate and may be subject to estate taxes. From a retirement perspective, a GRAT can be a strategic tool for individuals looking to reduce the taxable value of their estate while providing for their heirs. It allows retirees to transfer potentially high-growth assets out of their estate, preserving wealth for their family without incurring large upfront gift tax costs. The fixed annuity payments also provide a steady income stream back to the grantor during the trust term, which can help support retirement cash flow needs. In essence, a grantor retained annuity trust works by freezing the value of transferred assets for tax purposes while shifting future appreciation to beneficiaries with minimal tax impact. This makes it a smart consideration in retirement estate planning.